Okay, so now that we've had a chance to discuss what causes the term structure between currencies and commodities, I wanted to discuss a concept called spread trading, which is a way to apply this knowledge of how these term structures work in order to make money and find profitable trades. So, what is a spread trade, first of all? A spread trade is when we take two separate positions in the same commodity or currency, but on different futures ones. So they will normally be two separate opposing positions. So we might, for example, buy a March future and sell an April future of the same commodity. And we do this if we expect the spread or the differential between the futures prices to change. So, for example, if you were taking a position in a currency spread, you may be doing that if you think that interest rates will change soon, because as we discussed earlier, interest rate differentials are what create the different prices along each month. So if that's going to change, then those prices are also going to change. For currencies, it's hard to do because interest rates, because it's the only factor that affects it. It often gets priced in quite quickly. But for commodities, there's a lot more scope for this. So if market expectations, for example, think that commodities are going to rise a lot, we may think that market expectations are too optimistic, and that actually the rise won't be so high. So then we could take a short position in a longer dated expensive future and buy a long position in a cheaper current future. So again, when you're doing spread trading for commodities, you're primarily interested in market expectations of current prices and whether we think they are wrong or whether we think they're correct. There's not really much to do with storage costs in this case. So another thing to consider when it comes to spread trading is that sometimes longer dated futures are not as liquid as nearer term ones. So we always need to keep this in mind when trying to make a spread trade, that we do have adequate liquidity in the positions that we want to use. So as you can imagine, spread trading is a fairly low risk strategy, simply because you're buying and selling the same commodity just at a different month. So we're not really affected by the overall price movement of the commodity, but just the difference between the futures price. So it's a low risk strategy. It's also fairly low return because how much is the spread going to move over time? Not very much. And because of this low risk, low return nature, it's usually safe to use quite high levels of leverage, which is very common in spread trades, and sort of increase our returns that way. And in general, you won't be affected by overall market movements. You will mostly be affected by things that affect the movements within different months, which is fairly different. Okay, so that sort of encompasses what I wanted to talk about in terms of the futures prices and spread trading and how it all works.